Most investors spend a lot of time thinking about what investments they should own: stocks, bonds, ETFs, mutual funds, and how to pick each one. But there's another decision that can quietly cost people thousands of dollars in unnecessary taxes, and nobody ever thinks about it. That decision is where those investments are held. Because in many cases, where you hold an investment matters way more than what you actually hold. I'm Will Bristol with Advanced Wealth Advice with another personal finance hot take. In today's take, we're talking about the importance of asset location. Let me start by using an illustration. Say you come to my house and you're helping me put away groceries. You open up the refrigerator and see shelves full of canned chili, canned soup, and breakfast cereal. Then you go to put away the ice cream I just bought, and I tell you to put it in the pantry. You start to put the sugar and the flour in the pantry when I stop you and say, "Oh no, those go in the freezer." Well, of course, none of this makes any sense, but ask yourself why. Some of the things do much better with special handling, like putting ice cream in the freezer. It lasts a whole lot longer if you put it in the container designed for that purpose. Other things don't need that special handling, like the canned goods or baking supplies. Why would you use up limited space in your fridge or freezer when it doesn't really do you any good? I see people do this very same thing with their investment accounts all the time. And sometimes they even had a well-intentioned financial advisor help them put their groceries away. Because investments work the same way. Some investments generate a lot of taxable income every year. Others are much more tax efficient. Some have the potential for a lot of growth, and some are designed for more stable returns. And you have different investment accounts available that tax these investments differently or not at all. So the goals are simple. Put tax inefficient investments in tax sheltered accounts. Keep investments that get taxed at lower rates in taxable accounts. And hold high growth investments in accounts that have very low taxes or even better, are tax free. But many investors and advisors do the exact opposite, not on purpose, just because no one has ever taken the time to show them how this works. Is this you? If so, I'm glad you're here. And if you'd like to start sorting this out for your own portfolio, click the link in the details below or visit us at advancedwealthadvice.com to schedule a free initial consultation. I saw this situation recently with a client I'll call Jack. Jack had built a solid portfolio, but the placement of his investments was backwards. He was holding high yield bonds in his taxable account. That meant every year he was paying ordinary income tax on the interest. At the same time, he was holding low turnover index funds inside his IRA. Those funds are already tax efficient, so the tax shelter of the IRA really wasn't doing much for him. In other words, he was paying taxes where he didn't need to, and slowing down the tax advantages where they mattered the most. So we reorganized his portfolio, not by changing the investments themselves, although we did that as well, but simply by moving them to better locations. First, we moved bonds, REITs, and high turnover strategies into tax-deferred accounts like IRAs. You see, those investments generate income that would otherwise be taxed every year at ordinary income tax rates. And by the way, these tax rates are often the highest tax rates on your return. Second, we placed broad stock index funds in his taxable account. These tend to be very tax efficient because they generate fewer taxable distributions. And often those distributions are taxed at lower long-term capital gains rates. And finally, we made sure that the highest growth investments were held inside his Roth account. Why? Because if those assets grow the most, all of that growth is completely tax-free. Think of it like putting your fastest horse in the Roth stable. That's where long-term growth has the biggest tax advantage. So the takeaway here is simple. First, match the tax characteristics of an investment to the right account type. Second, when you rebalance your portfolio, think about the tax impact, not just the percentages of each investment. And finally, remember this rule. Where you hold an investment can be just as important, or often more so, than what it is you hold. When asset location is done well, it can improve after-tax returns without changing your overall portfolio at all. You're simply putting the right investments on the right shelves. If you'd like to see the framework that we use to organize investments across taxable, deferred, and tax-free accounts, I've included a link in the description below. You can find some time to schedule your free consultation with us. Thanks for visiting our Hot Take videos. I hope that you finish each one feeling a little smarter than when you started. Thanks for watching and have a great day.